Hi, everyone. Welcome back to Building Wealth $100 a time. Today in this episode, we're going to go over the portfolio. Typically, what we do in this video, go over our buys, go over our portfolio weightings and any news for the week. Now, obviously, if you guys don't, if you live under a rock, we had a pretty big week this week with Nebius earnings, Pagaya earnings, and a pretty sort of similar to last week, a pretty crazy week in terms of price action. So we'll go ahead and dive into the portfolio first, and then we'll kind of talk about some specific news, and things like that. But year to date, we're down 12.75%. Look at the SPY as a decent comparison year to date. I think probably pretty much flat, similar to last week. And then the NASDAQ is down 3.313%. So we're basically underperforming by a factor of four. Now, if we take a look at the past month, down 13%, past week, we're only down 3%. And then again, year to date, 12.5%, basically. Now, a big reason for that is obviously this SaaS and kind of just massive sell off in the market with high beta names. Um, we see on the right side here that Nebius is actually the only stock we hold that is currently green based on our average buying. And Zeta and Pagaya are down 23 and 30% respectively, which is pretty nuts. Now, I wanted to give a better visualization for you guys of how our portfolio looks. So, about a week ago or 8 or 9 days ago, we sold hymns off of the Wagovi news. And so people, I moved that money into NVIDIA here, as you can see. So right now it's currently 30% Nebius, and that's because we're a little bit of a gain. I've been buying 25% every week, but it's made a gain to make it 30%. Same with Zeta. I've been buying that at 25% each week. And so when we invest $100 a week, I'm buying 25 Nebius, 25 Zeta, but Zeta's gone down 25%. And so that's why we see kind of it being 22%. Now, Meta and Amazon are both positions that I've been buying at 15%, so they're around there. I basically moved all my HIMs in NVIDIA directly over. So that's almost 7.5%, and the big guys at 5, and IBIT's at 5. Now, if we take a look, just because I'm curious and for context, HIMs when we sold last week, we sold it around $23, I believe, and it's now at 16.15. So I'm glad I made that move. Now it's down an additional, what is that, 30%, 35% from when we sold. So I'm happy with the move. A lot of people were, pretty angry at me, calling me emotional. But again, it broke my thesis. The management team is more, incompetent than I thought. I didn't think they would go that route. But again, if we take a look, we sold around up here. Actually, we sold a little bit before that. We sold around $23 over here on February 5th or 6th, one of those days. So again, just kind of give you guys, again, the whole goal of this is to give you my thoughts and how I invest. And the thesis broke immediately, and I didn't think, and I sold. Now, obviously, if it went up to $35, I still would be okay with my sell because my thesis broke. Now, obviously, it feels a little better to sell, and then it goes down even more. It makes you feel like you made the right decision. But always, as investors, think about the thesis and not the stock price, right? So I held from 25 to 65, from 25 to 65, from 35 to 65, and never sold a share, and because the thesis was intact for me. And then it went down to $25. It also happened that the thesis also broke, in my opinion, based off that news. But yeah, that's him in a nutshell. Now, again, like I said, big week. So let's talk about one of our holdings, Nebius, our largest holding actually. They reported earnings. They crushed. Again, they missed revenue and EPS, but that's because there's only 4 or 5 analysts covering this company, and they just don't know how to guide for revenue, because they literally fully sold out of their capacity. And so how could they miss if they fully sold out? Again, you could kind of say it's some pricing structure, but again, I just don't think analysts understand how to value this company and how to give estimates. And so again, they sold out of capacity. They beat their ARR guidance of 1.1 billion to 1.25 billion. And again, for people that don't know, ARR is just the last 12 months, or the revenue of the last month about times 12. So that means in the month of December, they did 105 million in revenue. So you multiply that by 12, and that's 1.25 billion of ARR. They can maintain their guidance of 7 to 9 billion for 2026. They raised their capacity guidance, of more than 3 gigawatts. It used to be more than 2.5 gigawatts. It's kind of funny though how they try on this graph to depict like how big of a jump it is. I mean, I don't know, it just looks funny to me. 16 sites for 2026. They had 7 in 2025, which is insane. Group revenue was up 547%. AI revenue was up 802%. So their AI revenue 9x in a year. Just nuts. 24% adjusted EBITDA. I don't want to go through everything. Another couple key things was they announced that their stake in ClickHouse is now worth 25%. So we know it's worth 3.75 billion after that $15 billion raise round. They also said that 60% of their cash flows is going to fund their capex, which is amazing. It means they're going to dilute less than we thought, or at least less than I thought. And they also haven't used their at the money market debt offering yet. And they said they don't plan to use it anytime soon, but it's just another tool in the tool shed. So again, overall, I think it's honestly, and I've kind of said yesterday or in my earnings recap on Thursday, probably one of their best earnings to date, in my opinion. They crush on all metrics. The way they allocate capital and the way they're thinking about financing their capex is just, I think, the best in the market. And that's the reason why I like Nebius in the first place, right? Is they have the subsidiaries and they have other avenues. So, like I said, 60% is cash flow. But if they wanted, they still have 3.75 billion from ClickHouse, and they still have that 83% stake in Everett they can maybe sell off. Um, and so most of their capex spend, which they guided to 16 to 20 billion, so keep that in mind as well. They're a 20 to 23 billion dollar company guiding for 18 billion at the midline in capex, which is just insane. But again, most of it is going to be funded by cash, and I bet 80% of it will be funded by cash or selling off their some subsidiary things. And so we're in a great spot, guys. I think I went into this expecting at least a 10 to 50% dilution for the year, but I think it's going to be less than that, and I think this is really great as a shareholder. Now, moving on to our next stock that happened, they had earnings on Monday morning. This is Pagaya. So similar to Nebius, they missed on revenue, but they beat EPS. Now, analysts know how to guide for this company, so it's different of a miss. They did 335 million, up 20% year over year in growth. They did 53% growth in adjusted EBITDA. They also had a record GAAP net income of 34 million. Now, these are just the high level numbers. I don't want to dive too deep. I kind of had a recap video on Monday. Um, but essentially, what happened was the team and the founders and everyone decided that they want to be more conservative. And so they are reducing some of their higher risk debt or higher risk loans off the balance sheet. And so therefore they're slowing growth. And that's why they missed this quarter. And so they essentially said their goal is trying to be growing profitably rather than to grow at all costs. I like that mindset. I like that mentality. And so I'm okay with it. They basically said in the earnings call that their guidance for 2026, but I think was let me take a look. I think it was 1.15 to 1.3. They essentially said that their guidance was like worst case scenario that like if the Earth falls in and we have a massive financial crisis, they won't hit their guidance. But other than that, like they're essentially sandbagging. Is the tonality I got from the call. Here's some more numbers. 2.7 billion network volume, 131 million in their revenue fee from less production costs. This is essentially their gross profit. And then they had their net income here, 34 million. Now, if you take a look at 2026 guidance, trying to do a control F here to see if I can find it because they gave a good hint as to why. It might not be in the shareholder letter, but either way, essentially overall, the theme and the tone of the call was they're just trying to grow profitably. And so they're not trying to grow at all costs. But yeah, so that's essentially why they missed their earnings. I'm okay with it. Obviously, you want your company to grow profitably and grow crazy fast. And again, this is why I only made it, as you guys saw earlier, a 5% position. I still think they have some room to move down with the possibility of Warsh being appointed. And so, again, like I said, I'm okay with it being a 5% position. I think I like the company, I like the founders, I like the product, I like the value prop. But there is still some risk, and it is tied to the financial markets. And so, if let's say we don't see cuts this year, I think they're going to have the stock price is going to have a rocky time. And so I don't want to make it a large position. Whereas Nebius, Data, Meta, Amazon, I'm more confident in. And so that's why we kind of have those as higher names. Now, really, guys, the rest of the portfolio, there wasn't much news this week. Again, the reason we saw the massive sell-off in Zeta is just attached to SaaS. So again, another 10% week, down to 15.35 a share. Guys, this is, if we take a look, a billion, $3.181 billion company, which is just nuts. Super undervalued company. Hopefully going to be get profitable. If you look at the 1 month, it's just, I mean, you can look at it. It's just straight down. It's just an escalator, an elevator down. I mean, we were at $22 a month ago, 3 months ago, not too much, but in January, we're at 24.40. Now we're at 15.35. So we are down a crap load. Again, year to date, down 25%. We go ahead and take a look at Pagaya as well. Sort of baked into SaaS in a sense, but also a financial play. We look at year to date, 41% year to date, which is insane. Again, past month down almost 50%. So again, just getting destroyed with the rest of the market. Now, we take a look at our bigger names or our bigger tech cap companies. Meta, pretty much in our portfolio, only down 3%. Past week, down 3%. Past month, up 3%. And so nothing crazy bad there. Amazon's getting beat because they are building out a lot of capex, and so they will be negative free cash flow for the next month. And they also did a offering for the market, a share offering, I believe, probably raising, people were guessing $50 billion. And so they're tapping the debt markets to build for capex. And so I think that's sort of the negative sentiment as well, is just capex build out, which is funny because we saw an initial sell off in Nebius because of that. I think, like we take a look at the week on earnings. This is Thursday. Oh, that's not Thursday. I'm dumb. Thursday, we saw like a sell off in the pre-market, and then yesterday, massive move up, which was interesting. A lot of the data center plays had that move. But yeah, I mean, portfolio's trucking along. I will continue to invest. Like I said, $100 a week. The goal of this is to just have the $100 a week, maintain it, be disciplined with the approach, keep the same thesis, invest in the same positions every week if I want to. If something gets overvalued, don't buy. If it's undervalued, maybe I buy more of it. And that's sort of how I'm feeling to NVIDIA. I mean, we see all this capex guide, guys. Let's go into NVIDIA. I mean, it's just not like, who else is it going to? Obviously, there's other memory and chip names, but NVIDIA is going to get a large part of that, and so they're super undervalued in my opinion. I think they're trading like the lowest 4P they've ever traded at, for a company that's growing 55, 60% and has like 40 something insane in income margins. And so again, not even knowing the numbers, but understanding that all of this capex is going to NVIDIA, it just makes this easy for me. Um, and so yeah, again, guys, portfolio is doing, we're getting hammered. But as you guys should expect, or if you guys don't understand, like, this is just the nature of investing in high beta. We're down 12.75%. There could be a point in the year where we're outperforming the S&P by 4x. Right now, we're underperforming the S&P by 4x. And so that's just the nature of the volatility of a high beta portfolio. High beta meaning a stock that moves up and down a lot in terms of a percentage. And so that's okay. It's just a part of the game, part of investing. And I personally, I'm young, and so I like investing in high beta as it plays to my benefit because I have the time that most people don't have. If I wasn't doing that, I'd just be probably buying Nvidia, Meta, Amazon, names like that, that are a little bit lower risk. But yeah, appreciate your guys' support. Again, I'll be doing the same buys that I did this week: 25 Nebius, 25 Zeta, and continue to make pretty much equal weights to my portfolio. So one last time, here's sort of the portfolio and how it looks. And yeah, we'll keep the same weighting. Again, I'll keep around 5%. I do think we're probably heading into a crypto winter, or we're in already, as crypto's down a crap load as well. But yeah, I'll keep the position or the portfolio the same weightings and the same names. Again, 50% of our portfolio is going to be just two names, which can seem insane to most, but I prefer investing in this way. But yeah, one last thing too, guys. I don't want to jinx it, but Nebius is almost over 100. It's really trying. Yesterday, you can see here, it literally hit the $100 wall again. Again, it hit the $100 wall, and sold off. But maybe next week we'll see $100 and it'll be over the $100 mark. All right, that's everything this week. I appreciate you guys following. Appreciate you guys supporting. I'll catch you guys on the next episode of Building Wealth $100 at a time. Peace.